Hey there, fellow traders, and welcome back to a quick clip that I wanted to do on investing in index funds and ETFs. If you've ever thought about doing your own investing or growing your money on your own, or perhaps just helping your kids get started with investing, the choices can really seem overwhelming, and this video is for you. So we're going to go over some index funds, ETFs, and mutual funds, talk about the difference, and break it down the simplest way possible. This is going to be a screen share, so just roll with me as we go through this. And I'm going to share my notes and everything with you. We're going to do a little bit of this together. But again, my goal here really is to uncomplicate things for those of you who just want to get started or help someone else. One of the most common questions that I get is, where do I start? Again, maybe this is your first account or one for your kid, but the first step is always just to pick a brokerage firm. And again, this might be where you and your advisor currently work together, or you might want to sneak off and go somewhere and do this on your own. The good news is, again, you can go to Schwab, Fidelity, Robinhood, any platform, and just really quickly open up your own account. It'll take just a couple of days to do a funds transfer from your bank, and you'll be ready to roll. So that's definitely step number one. I wouldn't say that there's a strong difference between them. I generally find some platforms for me are just a little more intuitive and easy. I like to do things on my mobile phone. So I know I've been a proponent of Robinhood only for that reason. So the first step as we get started here is to understand the different options. And what I'm going over today is the idea of starting with one single index fund or ETF fund, which is a basket of stocks. So it takes all of the guesswork out. You're not picking Apple or Microsoft or FedEx. It takes all of that out of the picture. It also reduces a lot of the risk because now you're just buying into the index and you're saying, okay, there's been a market correction. I want to get in while it's low and I don't really know what to buy. So this takes the guesswork out of it. But there is a lot out there. So the question is, like, what do I buy? What's the difference? What are the pros and cons of each? And the best answer here is that you're really not going to go wrong. The market is so over diversified. Most of these things are all tracking the exact same stocks, and they're costing like within 100th of a percentage difference. So one of the things to start with here, and let me get up a screen share for you. So I'd like to just outline some of the differences between what is considered an index fund and an exchange traded fund. Now, if you have an existing advisor an account, then you probably have mutual funds in those accounts. Those might be actively managed by a fund manager, and you're paying a percentage of fees for that fund company to manage your fund. Something like American funds that used to exist, or a lot of these active fund managers who did really well and they beat the market year after year. Slowly in time got surpassed by passive funds like Vanguard. Those funds came out, and whereas something like, say, American funds was charging 3, 4, 5% to manage your fund, Vanguard came out and said, hey, we can do it for 0.1%. A very passive, a very little management. And they said, hey, we don't really need to mess with it. The index itself is pretty efficient. So we're just going to take out, strip all of those fees and just mimic what the index is doing. So that's really where index funds started. An index fund is not traded on the exchange during the day. So just like a mutual fund, it's priced at the end of the day. So you can buy, you can go in and say that I want to buy $500 worth of it. And that's going to happen at the end of the day. And it's going to tell you how many shares or even like a fractional share you purchased. But that's the exact same thing that really is happening with an ETF, an exchange traded fund, except an ETF trades like a stock. It's a bucket of stocks that have been bundled together, and then they're going to sell you one share. So the only difference between these two vehicles is how they trade. Not at all what's in them. So you can see in this scenario that I'm running for you, these are the exact same bundled stocks. So let that go. The difference too with the index funds, as I mentioned, as a mutual fund, is that you can buy in dollar amounts. And that's really cool, especially if you're dealing with a smaller account or someone who's just getting started and you want to do those as auto contributions. So if I want to put in $200 a month or $200 a week, I can do that. It will invest those $200, and I may be buying a fifth of a share or 0.38 shares each time. It doesn't matter. I'm buying it in dollars. So that's really convenient. With an exchange traded fund, you have to buy one whole share. So an example of, for example, IBV or VOO, some of those popular ones are trading at $500 a share. So if you put $300 in, it's going to sit there until you can afford to buy a whole share. And then each time you put $300 in, it's going to sit there until you can buy share number 2. So in my book, that's big negative for the exchange traded funds. Again, I don't want my money sitting there. I just want to be able to put in a certain dollar amount each month, have it pop right in and buy whatever it can buy. So that's a big pro for me of index funds over an ETF. Index funds may have a minimum investment amount, so that is something to keep in mind, though more and more they're not. And again, I'm going to show you some and really show you how you can get out from under that. But that used to be a really big negative for index funds. As I mentioned, the dollar cost averaging and automatic purchases is a huge pro for them. And then the other one that's really going by the wayside is tax implications. So with a mutual fund or an index fund, how the managers trade that fund is going to impact you. So if they swap a stock out, let's say they don't like how Microsoft is doing, and so they pull it out and swap another stock in, you can actually see a taxable event passed along to you as a shareholder. Whereas with an exchange traded fund, you do not get charged for those. You only have capital gains and losses as you buy and sell your own shares. So in other words, you control the tax implications versus with an index fund, just like a mutual fund at your broker, you're going to get a form at the end of the year that says, hey, you have these dividend reinvestments. And you're going to say, but I didn't do anything. And they're going to say, it doesn't matter. Inside of the fund, we are moving things around. And those are your taxes that we pass along to you. Again, in time, that has really been whittled down. These are both so passively and rarely traded. Again, they buy the index, they buy and hold, they're not moving around much. I think on my last dividend and tax funds for an index fund, I had about $5 for the year. I've been down to have like $30 or maybe $100. If that's a big thing to you, by all means, consider it here. Like I said, that's really becoming less and less. In both of these cases, again, you're dealing with a bucket of stocks. They're both very passively managed and they are both low cost. So let's jump back and look at some of the funds that I would throw out there and recommend for any beginner account. Now, in the top section, I'm looking specifically at mutual funds or index funds specifically. You will notice, to make this really easy, an index fund or a mutual fund always has 5 letters in its symbol. It's always really easy to tell them apart. The other key here is that they are typically available on each brokerage firm's platform. So if you have Fidelity, for example, buy Fidelity's fund, and there may be even incentives for you to do that. Same at Schwab or at Vanguard. So again, you don't need to go over to another platform. You'll notice that Fidelity on here, for example, has that Fidelity FZROX is the Fidelity Zero fund. It actually has a 0% expense ratio. The catch, you've got to be at Fidelity to have it. So they want you to get your account there, and then you can buy this nice freebie index fund. So it's pretty cool, except when you look at the expense ratios and you see that across the board, we are paying less than 0.05% for any of these. So if that's really driving you nuts and you need a 0 one, by all means. Otherwise, you're really splitting hairs. I wouldn't worry about the expense ratios at this point. I put them on here really to prove that point. The other thing that's really important to notice on here are the sectors. So the difference between an S&P 500 and a total stock fund, the S&P 500 are all large cap stocks. So those funds are specifically trading the 500 large cap stocks that make up the S&P 500. The total stock funds are tracking large cap, mid cap, and small cap funds. So it's really a total stock index. So you can get all levels of stock there. So it really is dependent on whether you like the S&P large cap funds or you want to get a broader swath. I wouldn't say that you need to do both. If you're ever in doubt, the S&P works just fine. Just pick that one. But just so that you know, the differences are here. Everything I am showing you, though, is U.S. equities. So if, for example, you wanted to branch out after you get started, you might want to do a U.S. equity fund, and you could do another fund that's, say, the Fidelity International Fund as the other half of your account. I'll get into that later, but for starters, just pick one of these, pick it with your own brokerage firm, and buy an easy one there. If you want to go the ETF route, again, if you are a little worried about taxes, you want more flexibility, you want to be able to trade in the middle of the day, and you want the trade to go through on the spot, you want to be able to call your price and buy one share, you can do that with an ETF. So again, ETFs don't tend to belong to a specific firm. You could buy any of these on any brokerage platform. Those are all ETFs with the exact same thing. Stay on, you can get a total stock and S&P, obscenely low expense ratios. So don't split hairs with these. Again, get whatever's available on your platform and what's easiest for you. Now, real quickly, I wanted to show you, I compare performance of these. And so there's a couple of things here that I thought were really interesting. This was simply for me an exercise in proving a point. I will admit that. But I think it was really cool because for those of you who really kind of want to get on the nitty gritty and say, are they the same thing? This was an opportunity to really show you. So looking here again, expense ratios are outlined just the same. We have year to date, 1 year, 5 year, and 10 year returns. And you can tell they really do mimic. These numbers are going to change from year to year and they fluctuate, but anything within a percentage point of each other is fine in my book, and you don't need to split hairs. The really important column here that I would call out is the minimum investment. So again, as I mentioned, you can buy an index fund with any dollar amount. You could take your $200 and just say, buy me as much of this fund as it can. The two Vanguard funds listed do have a minimum, and most all of Vanguard's mutual funds do have a minimum. Again, they were one of the first out there with the lowest cost. So what they're saying is in order to get into our funds, you need to have a minimum investment. I think now on their platform, if you have an aggregate across your accounts of a certain dollar amount, they waive that $3,000. Don't quote me on that, but if you're a Vanguard customer, you can check that out. But typically they do have a $3,000 minimum on their index funds. And then on the ETFs, you can tell by looking at this really how expensive the share prices are. So these are not $50 ETFs. It takes VOL, again, being one of the largest, most popular ones, $517 to buy your first share. So until your account gets there, let's say that this is your child and they're getting started and they're only going to be putting $500 in a month, they wouldn't be able to buy them for a share until month two. That's the same case with IVD and SPY, which again are some of the most popular ones. But for a small account, I really don't like that. It also means that the next 500 is going to sit there until they get to share number two. And that's going to fluctuate as the price of the fund goes up and down. I really just wanted to go through all of these to walk you through your options. Again, look at those top funds. I think that that is a really important um, measure of where to start. Don't overcomplicate things and over diversify. I will talk a little bit more about branching out outside of US equities. I guess people will say, well, I think diversification is a matter of broadening across sectors. And you're absolutely right. So in this case, you're fully invested in the US equities market. So going out there and throwing out an ETF or an index fund for international funds, you can even do it for bond funds. And then you can get really gnarly. They're out there for oil and gas companies and electronics and AI and utilities and airlines. You name it, it exists. We have never seen such a diversified market, but that can just be overwhelming and unnecessary in so many cases. So if you found this helpful, like and subscribe, drop me a comment in the questions. I love answering questions. Find me on Instagram and YouTube as well. I will definitely do more of these. I will link all of these slides in my show notes. Come back next week. I do a market update every Sunday night that I release. And I'll try and go over more and more topics as they come out and I got more questions from y'all. Thanks and have a great week.